Portfolio Strategy, the Boston Consulting Group BCG Matrix. Hey everyone, welcome back to the channel. Today we're diving into the basics of portfolio strategy, the Boston Consulting Group BCG Matrix. Let's get into it. The Boston Consulting Group BCG Matrix, developed by Bruce Henderson in the 1970s, is a strategic management tool used to analyze a company's portfolio of products or business units. It helps organizations allocate resources effectively by classifying their business lines into 4 categories based on market growth rate and relative market share. The primary purpose of the BCG Matrix is to assist organizations in 1. Identifying which business units or products to invest in. 2. Determining which areas require divestment or reduced investment. 3. Strategizing for long-term growth and profitability. The matrix is a 2-dimensional chart based on 1. Market growth rate, vertical axis, indicates the attractiveness of the market. High growth signifies a dynamic and potentially lucrative market, while low growth indicates a mature or declining market. 2nd, relative market share, horizontal axis, represents the company's competitive strength. High market share often correlates with cost advantages in market dominance. Quadrants of the BCG Matrix 1. Stars characteristics : high market growth rate and high relative market share. B. Significant revenue generation potential, but requires heavy investment to sustain growth and competitiveness. Strategy: A. Invest heavily to maintain or grow market share. B. Focus on innovation, marketing, and operational efficiency. Examples: a fast-growing smartphone model in a competitive market. Don't forget to subscribe for more information. Let's continue. So 2. Cash cows. Characteristics: A. Low market growth rate but high relative market share. B. Mature products or business units that generate consistent cash flow with minimal investment needs. Strategy: A. Milk the cash cow by extracting maximum profit. B. Use surplus funds to invest in stars or question marks. Examples: popular consumer goods like Coca-Cola in a stable beverage market. 3rd, question marks or problem children. Characteristics: A. High market growth rate but low relative market share. B. Often requires significant investment to increase market share, but carry high uncertainty regarding future success. Strategy: A. Analyze carefully to determine whether to invest heavily, to convert into stars, or divest if the potential is limited. Examples: a new electric vehicle model in a growing but competitive market. 4. Dogs characteristics: A. Low market growth rate and low relative market share. B. Products or business units with limited potential for profitability or growth. Strategy: A. Divest or discontinue unless they provide strategic value, e.g., synergies with other units. B. Manage as a niche player if it serves a specific purpose. Examples: outdated technology products in a declining market. Strategic implications: the BCG Matrix suggests resource allocation priorities. 1. Invest in stars to maintain leadership in high-growth markets. 2. Milk cash cows to fund other areas of the business while maintaining profitability. 3. Evaluate question marks to decide whether to grow or divest. 4th, divest dogs to reallocate resources to more promising areas. Advantages of the BCG Matrix: 1. Simplicity provides a clear framework for decision-making. 2. Resource allocation guides investment priorities based on market conditions and competitive position. 3. Strategic insights highlights areas requiring strategic intervention, such as diversification or divestment. 4th, dynamic perspective recognizes the life cycle of products and businesses. Limitations of the BCG Matrix: 1. Oversimplification reduces complex market dynamics into 2 factors, ignoring elements like customer loyalty, technological disruption, and industry trends. 2. Static analysis assumes markets are stable, which may not reflect dynamic real-world changes. 3. High subjectivity Classifying businesses into quadrants depends on subjective judgment about market growth and market share. 4. Ignores synergies, fails to account for interdependencies between business units. BCG Matrix and Nigerian industries. Example 1. Nigerian telecommunications sector. STARS. 5G technology initiatives by companies like MTN Nigeria in a rapidly growing digital market. Cash cows. Established 4G services generating steady revenue. Question marks. New digital service offerings like fintech products aiming to capture market share. Dogs, legacy 2G and 3G services with declining usage. Example 2. Nigerian fast-moving consumer goods, FMCG industry. STARS, innovative product lines, e.g., Indomie's new flavors catering to urban consumers. Cash cows, staple products like Milo or Peak milk in a stable market. Question marks. New snack brands launched to capture niche segments. Watching today's lesson? If you have any questions or thoughts, feel free to drop them in the comments. I'll be checking them out. Don't forget to like, share, and subscribe for more helpful content. See you in the next one.